Welcome back to lecture 4. In this lecture, we're going to be concluding the balance sheet and introduction of the new unit, which is unit 2, is going to be done. Okay, so follow me through as you um, understand the, the points from our last lecture. Okay, now, okay. Now, we are talking about equality of the accounting equation. Okay. Now, equality of the accounting equation. What we are simply saying is that the accounting equation that we've been looking at as the mother or as the core equation that summarizes all our interactions, including the balance sheet that we just started, is something that needs to balance up. Okay. Now it can be seen that every transaction has affected two items. Okay. Sometimes it has changed two assets by reducing one and increasing the other one. Okay, whereas in the other cases the effect has been different. Okay, now this is perceived on the balance sheet that we just looked at. We were able to see that from the assets things were able to move. Okay, it was the different transactions that were given were affecting the balance sheet or were affecting the equation differently. Okay, and because of that difference comes the issue of equality of the accounting equation. However, in each case, other than the every first, okay, when the business was started by the owner, he injected he injected some cash into it. Okay, he injected some cash into it, and that cash, we were able to see that that cash was $60,000. So he injected $60,000 into a business. Now, that injection of that amount, it there was no change. Okay, there was no change. So we're saying that the total of either of the section of the balance sheet were equal. Okay, and the equality between their two totals has been what? Maintained. Now, if you've seen, we've actually maintained those equalities. We've maintained those equalities since then, and now the equalities have what? Have maintained. Okay. Now, the accounting equation has held true throughout the example. Okay, and it always will. Okay, we've seen that the quality has maintained between the $60,000 and the which is and whatever transactions that came, it was leading us to $60,000. Okay, now we're saying that the accounting equation held true and it maintained and it always maintained. Now, the effect of each of these 7 accounting transactions upon the two sections of the balance sheet is shown below. Now, let's look at the effect of those transactions that we are dealing with. Okay. Now, you and I are able to understand as financial economists that every transaction that we incurred, okay, every transaction, excuse me, had a certain effect. Every transaction had a certain effect to the whole stance of the company. Okay, now let's look at an example. The first one, we are saying the owner pays capital into the business. You're able to see the capital, which is the $60,000. Now, when they pay the capital, the effect it has on the asset is that what it increases. Okay, meaning money at the bank increases. Okay, which means that there's an increase in capital. Okay, we were able to see that. Then further, secondly, when the business buys goods by check, okay, it decreases. We were able to see that after the business bought some products or some goods, the money at the bank or the assets in the bank decreased. Okay, which resulted into the increase in the what? Stock. When we talk about stock, we're talking about the goods. Okay, the goods of the company. Okay, so the stock increased. Okay, When the stock increase, it means that the money now that the company is holding, the company has shifted the money from the asset, the type of assets, from the money to the stocks. Okay, remember that all these are assets. Okay, remember that all these are assets. Thirdly, okay, we see now buy goods on credit. Okay, now when the company bought goods on credit, we saw the stock of the company increased. Okay, the stock of the company increased, and the liability of the company increased, meaning that, you know, creditors now came on board. Okay, creditors came on board. Why? Because it increased. Okay, it increased its liability, meaning that it borrowed, it got goods on credit. Okay, then fourth, we look at the sale of goods for cash. After the goods were sold on cash, we saw there was a what? Okay, selling of goods on cash. We saw there was a decrease in the assets, meaning the stock of goods. The goods were reduced and the money increased. Okay, whereas number four, we saw the sale of goods on credit. You know, the assets the asset decreased. Okay, meaning the stock of goods reduced. Okay, and increase was done in terms of what, the asset, meaning the data. Okay, now pay creditors. Now later the payment was done to the creditors, and we saw the money reducing. Then there was a decrease in liability. Okay, there's a decrease in liability, meaning the amount that was supposed to pay out, the our credit reduced. Now, debtor pays money owing by check. Now, further, the money was paid by check. Okay, meaning our bank account, the balance in our bank account increased. Okay, then on the other hand, we got a decrease in the what? In the asset, meaning the debtor, the amount reduced. Okay, now owner takes money out of the business bank account for own use. Okay, the bank decreases. Okay, it means that means that there's a decrease in the what, in the capital. Further, we have owners pay creditors from private money outside the firm. Okay, if you pay money outside the firm, we've got a decrease in the what, liability, and increase in the capital. Okay, whichever way that you do. Okay, now if you observe here, okay, if you observe here, you'll find that there is a two series transaction. Okay, there are two series transaction: money going out of the business and money coming in the business. Money going out of the business, money coming in the business. Now, whichever way that you do, money will either come in the business or money will either move out of the business. Okay, I believe that that is a very clear distinction and a very clear explanation. Now, if that is the case, now let's look at the balance sheet then. Okay, now this Mkawe guy, at the end of a month, on the 31st May, okay, he's able to have a balance sheet. Is able to have a balance sheet. Now let's look at how the balance sheet is now, a full one. Okay, so we know where the fixed asset, okay, where that amount bought he bought a shop. Then we've got the current assets. Okay, current assets, which is the stock of goods, which is 6,000. Then we've got data 4,400 $400. Then we have got cash at the bank 25,600. Then we add, then we get a 32,000. Then there we've got less current liability. Okay, now that meaning the liability, or what we have here, we've got the addition there. Then we've got less liability. Okay, now when we have less liability, our bank account has got 28,000 kwacha. I mean $28,000. Okay, and at the end of the day, it will balance out. It will balance out. We pay that 4,000, $4,000 to the creditor, and will remain with the money at the bank and the money in form of assets, which is in form of the shop, still comes to $60. I'm going to repeat this again. Okay. Um, Firstly, we remember that our case was that the owner of the business bought a shop at $32,000. Okay, $32,000. Now, at that $32,000, out of 60,000, he bought a shop. 32, he bought a shop. Okay, now mathematically, when you remove a a 32, you're going from 60, you're going to remain with 28,000. Okay, now that 28,000 is reflected here down. Okay, that 28,000 is reflected here down, which is the balance. However, for now, we are talking about further, this owner of the business purchased goods. Okay, purchased goods on credit. Okay, for what? For a 6,000. Okay. Further, they paid a 2,000, and they remained with a 400. Now, this 400 comes and you can see how it is drawing back to having our balance there. Okay. So, in case you've got problems, just be able to go back to where we were, where all these digits are coming from, and you'll be able to trace exactly how it is. Such as now, we've just combined everything. Okay, liability, and everything else. Okay, now the standard is the same. So first of all, have fixed assets. Fixed asset is the first one. Then you come to current assets. So current assets uh, in form of stock, okay, in form of money and other things. Then we've got a data, okay, a data who is having $400. Then we've got cash at bank. It becomes to 25,800 and 25,000 600, okay, dollars. Okay, then we've got less current liability, which is a 4,000, and we are good to go. Okay, that, it only takes practice for you to be able to understand fully how that one works. Okay, now you will have noticed in this balance sheet the term fixed asset. You will have noticed in this balance sheet the term fixed assets. Now, what is fixed assets? Okay, we've also have noticed the current assets and current liability. We've not yet defined what these terms are. Now, their definitions are as follows. Okay, fixed assets are assets which have a long life, bought with intention to use them in the business and not with intention to simply resell them. Okay, e.g., we are talking about buildings, machinery, fixtures, motor vehicles, and so on and so forth. Current assets. Current assets are assets that that are consisting of cash, okay, goods for resale, or items having a short life. For example, the value of stock in hand goes up and down as it is bought and sold. Now, basically here, when we talk about current assets, we're talking about something that can easily converted into cash. Or I mean something that is liquid, more liquid. Okay. But when we talk about fixed assets, it is something that is not easy, that is not liquid, something that is in form of buildings and in form of machinery, among other things. Okay, so current assets can be stock, meaning goods. Okay, in stock, goods in stock can be money. Okay, at bank, or money, cash. Okay, now similarly, the amount of money owing to us by a debtor will change quickly as we sell more to them on credit and they pay their debts. Okay, now the amount of money in the bank will also change as we receive and pay out money. Okay, let's hope that is a very simple concept. So we pay. Okay, as we saw in our above interaction here, we're able to see how the exchange is done. Okay, there's a quick swift. Okay, there's a quick swift as we receive money. As we receive money, our current asset at the bank increases. Okay, as we buy that, there's that interaction. Okay, so you need to be able to refer back to this interaction all the time. Okay, now, okay, so what about current liability? What about current liability? Current liability are those liabilities which have to be paid within or no more than a year from the date on the balance sheet. Now, current liability are the amount of money that your business is owing to other firms or organization within the less or the period of less than a year. Okay. E.g., we're talking about creditors for goods bought. So if we're talking about current liability, we're talking about something that you have to pay in within a short period of time. Okay. But of course, we're talking about the short of period of time. We're talking about less a year. Okay, less than a year. We need to be able to have these amounts. Okay. Now, okay, I hope that is a very, very clear distinction. Okay, now let's go to unit two. Okay, now unit two, we're just like picking it up now. Okay, we're just like picking it up to 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 bring in more understanding. Okay, now as we go further, you understand that these things are marrying each other. These things are complementing each other. Now, as these things are complementing each other, as we go, you'll be able to understand and put dots together. However, for now, would like you to follow through and be able to understand and study and be able to bring out these concepts even when you're not watching this video. In unit one, we looked at how various events had changed, you know, two items in the balance sheet. Okay, events which result in such changes are known as transactions. Okay, so we looked at what was happening there. Okay, the exchange, you give, you get, you give, you get. Okay, and those events are called transactions. This means that if the proprietor asks the price of some goods but does not buy them, okay, then there is no transaction. That should be very clear for any business. If a person comes, they ask for a price and they don't buy, that is not a transaction. Okay, it becomes a transaction if a person actually asks or just come and buy. Okay, so when a person buys, when the money enters or when you receive the money, okay, it means that a transaction has occurred. Okay, a transaction has occurred. Now, um, and on the balance sheet, on the balance sheet it is reflected. Okay, two balance sheet items would then have to what to be altered. Now we've got money coming in the business and money going out of the business. Okay, money coming in the business and money going out of the business. Now, if there are those issues, then there are two entries in a balance sheet. Okay. Now, because of that, this concept introduces us to what we call the double entry system. The double entry system. Okay. We've seen that every transaction affects two items, right? Okay. We need to show these effects when we first record each transaction. That is, when we enter the data relating to the transaction in the accounting books, we need to ensure that the items that were affected by the transaction and only those items are shown as having changed. Okay, now this is the bookkeeping stage of accounting and process we use in code entry. Okay, double entry. Now, here what we're just trying to say is that when you have when we have got those two series, okay, of transactions, okay, we call it a double entry. Okay, a double entry. You will often hear it referred to as double entry bookkeeping. Okay, double entry bookkeeping. Okay, either term is what correct, either double entry or double entry bookkeeping. Okay, which just means that the transaction, there were those series of transactions either coming in or going out. Now, if we want to show the double effect of every transaction when we are doing our bookkeeping, we have to show the effect of each transaction on each of the two items it affects. For each transaction, this means that a bookkeeping entry will have to be made to show an increase or decrease of one item, and another entry to show the increase or decrease of the other item. From this description, you will probably see that the term double entry bookkeeping is a good one, as each entry is made twice, okay, which is double entry. Okay, so each entry is showing twice, okay, showing on the part of coming in and the part of going in. So we're going to show whether this part is going in or this part is coming going out of the company. Now you are going to understand better as we look at other units of this study. Okay, for now hold on and just try to understand that the two entries, it means that double entry, it means that one transaction is reflected in two ways, okay, on the balance sheet. Okay, at this point you may be wondering why you can't just draw up a new balance sheet after each transaction and so provide all the information required. Instead of constantly drawing up balance sheets after each transaction, what we have instead is the double entry system. Okay, so this process is called double entry system. Okay, now the basis of this system is that the transaction which occur are entered in a set of accounts within the accounting books. Okay, an account is a place where all the information referring to a particular asset or liability or to capital is recorded. Now that's what an account is. Okay, an account, you are saying, is a place where all the information referring to a particular asset or a liability or to a capital is recorded. As simple as that. Now there will be an account where all the information concerning office equipment will be entered. Similarly, there will be an account for buildings where all the information concerned with buildings will be shown. This will be extended so that every asset, every liability, capital will each have its own account for transaction involving that item. Okay, so basically we're talking about every part of the business, okay, has got its place. Okay, there's a place where you keep documents for business, for the building, rentals, other costs, other utility bills, among other things. They have a file. Okay, each cost has got a file. Okay, now equally, even in this area, that's what we're talking about. Okay, there will be double entry. It means that all those costs come, they are either coming to the business or moving out of the business. Okay, however, they may have subcategories. Okay, now thank you so much for being with me in this video. I hope we'll be able to highlight more and more and more in our next video, which is lecture 5. For now, it's goodbye and God bless.